Hi. So we are starting with corporate issuers, and amongst your all the 10 topics that you have in CFA, trust me, this is the easiest of all the topic and the most most profitable topic. The ROI, return on investment on this topic is the highest. Ask me why. Because there are only 7 readings and you have around 11 to 16 questions asked in exam. Now, imagine the hard work that you put in QM. Compare that with corporate issuer. These are all very brief, short topics, not too lengthy, no rocket science at all, hardly any calculation except one or two places like working capital and capital investment, which is so easy to calculate. So this is a topic which is the smoothest, easiest, no complicated variety, nothing out of the syllabus. Even if you try doing a lot of questions, you will realize that there are not too many questions. Okay. So these 7 readings we are going to take over one by one. We'll begin with the first, that is the organization structure, where they are going to talk about partnership, sole proprietorship, and so on. Then we'll move gradually towards corporate governance and stakeholder theory and so on, where you have slight discussion about ESG. Unfortunately, ESG discussion they've done in multiple places throughout the curriculum. Then you're going to discuss about working capital and liquidity, where your ratios knowledge is very important, especially when it comes to cash conversion cycle. Then the easiest of all the topic is capital investments, where you're going to calculate NPV and IRR. And finally, capital structure, which is very crucial, where you're going to discuss the very famous Modigliani-Miller theory and the static trade-off theory. At the end of the day, you're going to discuss about business models, which is about what are the different ways of doing business. Correct? Very easy, very brief, a very enjoying topic. No rocket science here. Okay, so let's begin with that. Everyone, perfect. All right, let's start. Now, one more very interesting thing I want to tell you about, many times students ask me, sir, should I do the question from here, there, all? Let me tell you one thing. If you go to the CFA Institute questions about corporate issuers, have you noticed something? Have you noticed? All are case studies. Do they ask you case study in level 1? Of course not. So, see, many students tell me that, sir, I will do only CFA Institute question, they are best. I don't disagree. But you need to be rational that case study is not asked in exam. So look out at corporate issuer questions in CFA Institute and you will realize they are not something that is going to be asked in exam. So that's why, you know, it's not one resource. See, as a professor, we know which resources are better and all. So that's why, sometimes it's okay to not just depend on one resource, correct? When it comes to question solving, you can do wherever you want. Okay, perfect. I'll start with the questions, right? Right. It's in the flow, right? For your understanding, you can answer in the chat box. I would be very happy if you participate. And then what we will do is that we will take it further. Okay. Right. Let's go. First one. Very easy. Under a limited partnership, there must be at least limited partnership, right? Sole proprietorship. See, just to give you an idea, what are the structures here, guys? Sole proprietorship, general partnership, limited partnership, and then you have corporation. Corporation is where you have double taxation issue. Limited partnership generally is the case in LLC or LLP, right? There must be at least one general partner and one limited partner, or one general and two general. No. What is the easiest answer, everyone? Come on. At least one general partner and one limited partner. Everyone with me? Check, 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 check. Yes. You need at least one of them, correct? General and limited partner. Remember, general partner is the one who runs the show. Limited partner is only investor and has a limited liability. Next, in partnership, a general partner's liability is, I just discussed, is, come on, answer everyone on the chat box. ABC, general partner's liability, guys, is unlimited. Understood, everyone? Perfect. Hello? Check, check, check. The KRD's liability for business obligation of sole proprietorship. In sole proprietorship, guys, I am the only investor, right? In sole proprietorship, also the liability of the owner itself is, everyone, limited, unlimited? Check, 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 check. Everyone, yes, is unlimited. Guys, only in the case of corporate, the investor's liability is limited, or only in the limited liability, the limited partner's liability is limited. So many limited. Understood? So same way, in a limited partnership, the limited partners see receive a smaller share of profits than general partners, manage the business. Do they manage the business? No, it is general partners. Are not involved in decisions, true, but appoint and remove general partners. Everyone. Now, see which one is more correct. Limited partners are not involved in decisions, true, but appoint and remove general partners. Is that correct? No. A is the answer. Can someone tell me why A is the answer? Everyone, yes. Why do they receive a smaller share of profits? Because general partner has an additional component. What? General partner is going to get fees to run the company, right? So the limited partner is going to pay an additional component to the general partner for running the show, for managing the business. Am I correct? Therefore, proportionately, the share of general partner is higher. Agree, everyone? Which of the following statements comparing corporations and general partnership is most accurate? Owner liability is only limited under a corporation, only corporation, yes or no, everyone? As I said, the liability of owner is only limited under corporation. In general partnership, not everyone has a limited liability. Understood? In fact, in general partnership, there are no limited partners. In limited partnership, there are limited partners. Correct? So that is the difference for sure. Let's check B and C also. Access to capital is easier under general partnership? No, it's easier under corporate. Both are separate legal entities? No, in general partnership, sole proprietorship, there is no differentiation between the owner's liability or the company's liability. Correct? So what is the correct answer, everyone? Owner's liability is only limited under a corporation. Everyone with me? Check. Correct? Okay. Now, I want everyone to answer this. Okay, don't feel shy. I'm seeing not everyone trying to answer. A corporation that wishes to raise equity capital and have its shares publicly traded is most likely to engage in management buyout, direct listing, and IPO. You know what? These type of question, I know they are very easy and student doubt it, but anyone who makes mistake in these types of questions, trust me, they should not give CFA. This is so easy, isn't it? This is the reason why you start doing CFA, because you are excited towards the capital market, right? So corporate, you know why am I? I'm not kidding. In corporate issuer, your goal should be to get 100 on 100. Okay. Next, under which business structure are profits potentially subject to double taxation? I just discussed only one structure. Which one, everyone? Corporation is faced with double taxation. Double taxation. Now, you know what? I'll tell you one very interesting story. I take CFA sessions in many different countries. So let me tell you what you feel is general knowledge is not the general knowledge everywhere. Okay. Many people are not aware about these structures. So sometimes, I feel, oh, what is there to discuss about? It's so easy, right? But trust me, it's different in different part of the world. Okay. So I'm just sharing you that experience. Next, everyone. So remember, I told you that there are 7 topics. We are now gradually moving towards the other topics. Okay. Now, of course, in exam, you're going to get mixed, so you should not be worried about that. But the second topic is more about discussing about the stakeholder theory and so on. The interests of community groups affected by companies' operations are most likely to be considered. See, when I talk about the entire community, it's not shareholder. Shareholder is only equity shareholder, but stakeholder is more comprehensive. So what is my answer here? It's called stakeholder theory. Got it, everyone? Right? Guys, keep putting up in the chat box. Okay. Here answers ABC, ABC, ABC. The stakeholder theory of corporate governance is primarily focused on increasing the value of the company, resolving conflicts between management and other affected groups, prioritizing stakeholder interest over shareholder interest. Everyone. See, increasing value of the company was a traditional shareholder theory. Number one. Resolving conflicts, principal agent issues. Yes, that's fine. Prioritizing one over another is not a stakeholder theory. Stakeholder theory is more comprehensive. Shareholder theory is prioritizing one over another. So what's your answer, everyone? A, B, C, A, B, C, A, B, C, everyone? B is the answer. Clear, 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 right? Resolving conflicts among different stakeholders. That's the focus of stakeholder theory. It's more better. I mean, it's much better than the shareholder theory, which was in the past, focusing only on wealth maximization. Got it? Next, increasing a company's risk exposure to boost growth is most likely favored by, see, there are multiple stakeholders. Everyone have different objective and the conflicts are common, right? Now, here the answer is who wants to increase the risk of the company? Owners, but not lenders, neither lenders nor owners, or both. Guys, who wants to increase the risk of the company? It is the owners, right? Because owners portfolio is more diversified. Lenders don't want to take risk because there's no point of taking risk because they're going to get limited returns. They are not going to get the residual returns. So lenders don't want the company to take risk. This creates principal agent issue. Understood? Next, the stakeholder group that typically prefers the greatest amount of risk amongst the three: directors, shareholders, and senior managers. Everyone. See, here also the answer is shareholders. Some students ask me, sir, why not senior managers? Of course, they do want company to take more risk if majority of their compensation is tied to the ESOPs or to the stocks, right? However, shareholders always being diversified, they want to take more risk. I'll repeat, between senior managers and shareholders, shareholders always prefer more risk. Got it, everyone? So it's not C. Relatively, B is the answer. Shareholders want to take more risk. Understood, everyone? Under shareholder theory, not the stakeholder theory. Now we are discussing shareholder theory. Corporate governance is primarily concerned with managing conflicts between managers. Where is the biggest conflict? Between managers and employees, managers and customers, or very easy, managers and we have a conflict between managers and owners. Owners can be the shareholders or board of directors, whichever, okay? That's the biggest conflict. Again, I'll repeat, what is that called as? Principal agent problem, okay? The shareholder least likely to prefer a riskier strategy for potential superior performance. I've already discussed who's going to be the case here. Creditors want less risk. Suppliers also want less risk. But relatively, who wants lesser risk? Between creditors and suppliers, it's the creditors who want less risk. Understood? Got it? Which of the following payments are contractual obligations? Guys, this is very interesting. Many people don't know, but equity dividend, is it compulsory to pay? Is it compulsory to pay equity dividends? Check, 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 check. Do we have a compulsion to pay equity dividends? No, right? Preferred dividend? Preferred dividend, is it compulsory to pay? Tell me. Is preferred dividend compulsory to pay? No, this is, you know what? I will tell you one thing. When I studied in my university in India, even I thought that preferred dividend is obligation. Guys, the only obligation, contractual obligation, is to the debt holders. Is only to the debt holders, and therefore interest and principal is the only obligation. Preferred dividend is not contractual obligation. So if the company doesn't have enough profit, they can skip the preferred dividend also. Are you with me? Right? These are all notions that even I thought, oh, preferred dividend. See, you know why people think preferred dividend is obligation? Because preferred dividend is fixed, like debt interest. So they think it's an obligation. No, it's not an obligation. Preferred dividend is to be paid only if the company has profits. Debt interest, you have to. Principal, you have to. It's a contractual obligation. Otherwise, the company defaults. Got it, everyone? Very minor but interesting thing. Next, the committee. See, the under the corporate governance, the board of director makes several committees for different reasons. So the committee responsible for establishing CEO's compensation. What is that committee called as? It's called the same compensation committee, or it has a different name called remuneration committee. Understood? Everyone? Easy? Risks that may arise from ineffective corporate governance least likely include, means which one is not the risk? Reduce default risk, guys. If there is corporate governance issue, default risk will reduce? No, it will increase, right? So that is incorrect. Remember, whenever they say least likely, you are looking for incorrect answer. Whenever they say least likely, take a pause, take a deep breath, and remember, least likely means you're looking for the wrong answer. Okay. Next, a principal agent relationship most likely exists between customer and supplier, directors and regulators, shareholders and managers. Very easy, very easy, very easy. Check, 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 check. It's A, customers and managers. Principal and agent relationship exists between who? Guys, principal is the one who allocates the task to the manager or to the agent. So the agent has a responsibility to report to the principal. What is that case, everyone? C, right? Shareholders and managers, not A. Understood, everyone? The board nomination committee is least likely responsible for. See, the nomination committee's job is to find right candidate for the board elections. Okay. So they check the background, qualification, experience, and so on. So is least likely responsible for evaluating directors' independence? No, that's their job. Recruiting board members, again, that's their job, right? Selecting an external auditor, no, that's not the job of the nomination committee. Everyone with me? Correct? That's not the job of the nomination committee. For that, you have a separate committee called the audit committee. It's the job of the audit committee. So it's not the job of nomination committee. It is the audit committee whose job is to select the external auditor. Understood? Okay. Now, something that I have seen in the notes, but I mean, I've put up in my notes, but I don't think many people have this in their, notes or something, is a very interesting thing about the working capital. A moderate working capital strategy. See, for this, I will just show you because I don't think so many people have this idea. So from our notes, I will just tell you that there are three forms of working capital. Basically, we have a conservative, aggressive, and moderate approach to effectively manage the working capital, right? Now, here they asked us which one? They asked us a moderate. Moderate is neither aggressive nor conservative. What is a moderate approach? Moderate approach says that all those who are permanent assets are for long term or short term. Permanent assets are for long term or short term, everyone? Long term, right? So permanent assets should be funded by long term funds, and seasonal assets should be or can be funded by short term funds. So why A is the answer? Permanent assets should be funded with long term funds and seasonal asset with short term funds, right? So this is what is a moderate approach. See, moderate approach, permanent asset with a long-term source and seasonal asset with a short-term source. Conservative is more safer, where you rely more on long-term sources for protection. Why? Because you need consistency. Aggressive is where you use short-term funds because short-term funds are relatively cheaper, but then you have a rollover risk. You have a risk to rollover. That's a lower risk when it's conservative approach, a higher risk in case if there is a crisis like situation. Okay. This, if you have my notes, this is very important. Effective working capital management, where I've summarized it very well. Thank you, Kunal. Okay. Next, everyone. A company has prepaid sales and low inventory. Prepaid sales, prepaid sales and low inventory. This most likely indicates means what? There is a high demand, but there is no inventory. See, my situation. I have a high demand, but I have no inventory. I have no tech and other expertise to deliver so many. So, what is this? A low cash conversion cycle, a high cash conversion cycle, high days of inventory in hand. Everyone. What should be the answer? A low cash conversion cycle. Can you tell me what is a cash conversion cycle? Check, 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 check. Cash conversion cycle is days of inventory plus days of sales outstanding minus days of payables outstanding, right? Minus. Now they are saying company has high prepaid sales. Guys, if my prepaid sales are higher, that means my days of sales outstanding, people have paid me in advance. So my days of sales outstanding will be low, isn't it? Correct? But low inventory, I don't have enough inventory on hand. So this is unfortunately higher. Correct? This most likely indicates a low cash conversion cycle, a high cash conversion cycle, or what exactly? Yes, try and let me know. See, what is a low cash conversion cycle? Low cash conversion cycle means you are able to convert the inventory into cash faster. Guys, here my inventory is low. If I have a lot of inventory unsold, then my days of inventory is higher. But here they said inventory is low, so I don't hold enough inventory, right? So my inventory is low, so actually my days of inventory will be also lesser. I'll repeat. They said inventory is low, so my days of inventory will be lesser because I don't have enough inventory. If I have a lot of inventory and unsold, then days of inventory is higher. Plus, my days of sales outstanding is also low because people are paying me in advance. So I don't need enough, daters, or I don't have enough receivables. Correct? Because of this, my cash conversion cycle is going to be lower, lower, lower. Everyone agrees with me, right? So prepaid sales will reduce my days of sales outstanding, and lower inventory means my days of inventory will also be lower. Actually, it's a good sign, right? Your cash conversion cycle is less. But let me just add you one interesting thing here. You are running out of inventory. That means you need to have more inventory. You lose the business otherwise. Understood? Clear? Next, this one very interesting. If the days of inventory on hand, days of sales outstanding, and days of payable all double, the cash conversion cycle, would it increase by a factor of less than 2, double, or remain unchanged? Let me know. A, B, C. Very interesting. Everyone agrees? Double, double. Very easy, right? Suppose your cash conversion cycle, days of inventory is 10 days, days of sales outstanding is also 10, and days of payable is 5. So this is going to be 15, right? If you double everything, 20, 20, and 10, okay, this is going to be 40 minus 10, this is going to be 30. Correct? Some people try to apply complex math here. Oh, it's going to remain the same. No, 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 it's not going to remain the same. It will double. Got it? The cash conversion cycle would most likely decrease. See, for the cash conversion cycle to decrease, days of inventory should go down, days of sales outstanding should go down, or days of payable should increase. So which one, everyone in the class? The cash conversion cycle would most likely decrease if days of sales outstanding increase? No. Days of payable outstanding decrease? No. Days of inventory on hand decrease. Am I correct? Everyone agree with me? Check, 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 check. Right. Okay. Now comes very interesting thing. This is one of the calculation that many students struggle with. Okay. This is basically your effective rate. Have you seen this example? Effective rate, right? How to find the effective rate? This is very interesting calculation in working capital. How is it mentioned? 430 net 10. What does it mean 430 net 10? It means 4% discount if you pay in 30 days. Otherwise, the credit period is how much? 90 days. So this is the discount that you will get if you pay in 30 days. Understood? But the bank rate is 6.5. Which financing is cheapest? Here, you need to calculate the effective annual rate. Effective annual rate. What is the formula of effective annual rate? Normally, students have to memorize it. I will share you the formula in my notes. I have mentioned the formula here, but in exam, of course, you are not going to be in the position to memorize the formula. See, this is the formula in my notes in the flip book of revision. This is your effective annual rate formula. Do I have to remember the formula? No, we are not going to go with the formula. I'll tell you how to process this. So see this. First of all, I always prefer to do timeline to understand the situation better. Okay. So what is the question saying? That see, if you pay in 30 days, you will get 4% discount. That means you will only pay, let's say the invoice is of $100. So you'll only pay 96. Am I correct? If you pay within 30 days, you will pay 100 or 96. You'll pay 96, isn't it? I'll repeat. If you pay in 30 days, you get 4% discount. So you are going to pay only 96. Agree, agree, agree. However, you won't get the discount if you pay after 30th day. So after 30th day means imagine you pay on the last day, 90th day. Correct? So how much will I pay? 100. Isn't it? So basically, guys, if you notice here, how much are you losing by not taking the discount? Can I say it's like a loan? It's like you've taken a loan where you're going to pay $4. You're losing $4, right? And how much is the loan? The loan that you're getting right now is 96. So basically you're borrowing 96 and paying 100. Can I say it's situation like this, right? So the effective annual rate formula is basically how much are you paying? You're paying $4, that is 4% on 96. On 96. This is what you are paying as an interest. But for how many days, guys? This is for the gap of how many days? What is the gap here? For additional 60 days. Am I correct? So I need to annualize this. How do I annualize it? 365 over 60. And then I calculate -1. Understood this part? Everyone? So it's like, you know what? I am borrowing 96 right now, will pay 4 and eventually pay 100. So basically you're paying 4 on 96 borrowed today. For a period of how many days? How many extra days? 60 days. That's going to be your effective annual rate. Can you calculate this? How do you calculate this, guys? First, in your calculator, do 4 divided by 96 plus 1. That is 1.0417 and store it. Store 1, store 1, store 1. Then you do 365 to annualize it. Divide by 60. Extra days are 60. Store 2. You will get 6.08. So store 2. Now you do recall 1 to the power yx recall 2 and then press equal to. I want everyone to tell me what is the answer that they have got. Have you got 28.19 percentage, 1.12, 1.2819 minus 1 into 100? Have you got 28.19 percentage? Check, 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 check. Got it? That means if you don't take the supplier's discount, your opportunity cost is you're losing 28 percentage. And the bank is providing you capital only at 6.5%. So what is better? It's better that you borrow from the bank and take the supplier's discount and don't lose the 28.5%. Are you getting me? So the answer is, which financing is cheapest? The bank's financing is cheapest. You know what? Actually, many students tell me, sir, isn't that always the answer? The bank financing is cheapest. Yes, most of the time it is, but you should know how to calculate this. I use this timeline method, makes it easier for me because I think from the bonds point of view. Understood, everyone? Clear? The other thing is memorize the formula, which is not feasible. Clear? See, there are very few cases in corporate issuer which has calculation. So for me, this is very important question. Understood? Clear, everyone? Just confirm me on the chat box if you have understood. Check, check, check. Perfect. Yes. Quick ratio, guys, quick ratio is current assets minus inventory, which is quick assets and sometimes prepaid expenses, right? Divided by current liability. Okay. Is more conservative than current ratio because it excludes what? Very easy. It excludes inventory. Understood? Actually, it also excludes one more thing, prepaid expenses, but CFA Institute doesn't focus much on that. It just focuses on inventory. Clear, everyone? Which is the strictest cash ratio. The cash conversion cycle is most accurately, everyone, yes, days of receivables, okay, days of inventory minus days of payables. It shouldn't be plus. So the answer is C, C, C. Very easy. Clear? Guys, you all are not putting in the chat box, okay? Which scenario reflects an aggressive approach to working capital? Guys, aggressive approach means you are relying more on short-term funds because they are cheaper, but then you face rollover risk. That's aggressive approach. So aggressive approach means short-term funds or long-term funds? Short-term funds. Advantage, cheaper. Short-term funds, short-term interest is low, correct? But the risk is rollover risk. Remember, the risk is rollover risk. That's why it's called aggressive approach. Now comes project financing or capital investments. Now, in capital investments, you have real options. Real options are the options that you get in the projects. So when you do projects, what are the different types of options that you get in the projects? These options are timing option, abandonment option, expansion option. Here, if you notice, option is an advantage, right? So options, they are advantage, and the value of option should be included in the project. And option premium cannot be negative. So guys, a real option, can it be negative? No, it can never be negative. It's an advantage in the project, right? So a real option is always positive. It can never be negative. Also, you can connect your derivatives knowledge. Option premium can never be negative. Understood? Clear? Right? A company opens a new nickel mine after price rise. Nickel mine, why? Because nickel is a superb component. It's without that, batteries are impossible. Most of the nickels are in domestic Republic of Congo. It's the world's biggest resource of nickel, but also the world's poorest country. I don't know why. Yes, so a KRD company opens a new nickel mine after price rise. This is best described as which model? Yes, expansion, fundamental, or flexibility. See, expansion is where you do a project and further, it's like a call option. If you do it well, then you get an expansion. So this is not expansion. The mining is opened based on the underlying prices of the asset. So based on the underlying prices of the asset. So look at this, everyone, timing option, abandonment, expansion option, fundamental option. See here, the project pays off dependent on the price of the underlying. Got it? So here, why is this guy delaying the opening of the mine? Correct? Or depending, why is he depending the opening of mine on the prices? Because maybe the payoffs are based on the underlying asset. So which option is this, everyone? Can you let me know which option is this? Check, check, check. Hello, hello. Yes, fundamental option. Flexibility has two options. See, flexibility has price setting. You can change the price, or production input flexibility. So it's not fun. It's not the flexibility option. Okay, right? Next, very easy question. Firm invest initial cash outflow of this. This is your CF0 and expects returns over the next 5 years as below. This is going to be your C01, C02, C03, C04, C05. Cost of capital is 8%. This is going to be your I by Y. You need to calculate NPV. Let's go to the calculator. This is the easiest of all these things. CF second clear. Second clear. I'm going to put 336875. Positive or negative? Negative. Enter. Okay. Then go to C01. Everyone, C01, 100,000. Enter. C02, 82,000. enter C03, 76,000, enter, ignore the frequencies, okay? C04, triple 1,000, C05, 142,000. NPV, you put the discounting rate 8, enter, down arrow, compute. Let me know what's the answer that you get. Everyone in the class, check, 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 check. Let me know. 336,875, 100,000, 82,000, 76,000, triple 1,000, 142,000, everyone. NPV discounting rate, you put 8, enter, compute. Yes. What's the answer are you getting? Are you getting an answer? Check, check, check. Yes. Awaiting your information. Please tell me. 64, everyone, 64,581.75 to be precise. That's closest to A. Are you getting A, everyone? Check, check, check. Right? You'll get 64,581.75. I hope you've put correct numbers. Right? Easy. Next, a project yields 3,000 annually. Means this is going to be your PMT, right? For 5 years, this is going to be your N. Cost of capital is 9.7. This is going to be your discounting rate. What is the NPV? Means you have to find PV. Easy. See, when you have recurring amount annuity, you can do the PMT function. What is missing here? The FV is not given. So you can assume FV as 0. A 10,000 project. What are they looking for? NPV, right? NPV, NPV, NPV. Cost of capital is provided to me. So 10,000 is the project's initial cash outflow. You can also go to the cash flow function and place everything. You can do it both ways. What you can go to the cash flow function, second clear. In your CF0, it should be minus 10,000, 10,000 negative, enter. C01, guys, you will put 3,000 and frequency you put 5. So 3,000, enter, frequency 5. Why? Because it is repeated 5 times. Same. That's it. There is nothing remaining. There's no need to put any FV there, right? Press NPV. It asks you I, that is 9.7, enter, and then compute. You should get 14,61460. Isn't it? 1460. Are you getting this? Are you getting this? Check, check, check. 3,000, frequency 5, NPV 9.7. Right, compute. Are you getting 1460, everyone? Yes, go ahead. Yes, please tell me.
So how are we supposed to do without the cash flow function?
You can do without cash flow only if the amount is not amount is recurring, annuity. First of all, here, see, with cash flow function, did you get 1460, everyone? Then I'll explain you other way also. Have you got this answer, everyone? Please let me know. Yes. Okay. Now let me tell you other way. See, here you can use the PMT function because the cash flows are same. So what you can do is that put 30,000 PMT payment, 0 FV, 9.7 as I by Y, correct? 5 as N, and compute PV. You will, when you compute PV, you'll get 11,000. Sorry. Yeah. What is that you get? When you put 3,000 PMT, 0 FV, 9.7 as I by Y, 5 as N, compute PV. Are you getting 11,460 as the answer? You'll get 11,460 as the total value. That's your present value of cash inflow. Your outflow is 10,000. So if you subtract the outflow, what remains is 1,460. Understood? So then you'll have to first find the present value of the cash inflow, then subtract the outflow from it. That's how you get the NPV. Both ways are possible, but remember the PMT function is only possible when you have annuity. Otherwise, you have to go to the cash flow function. Got it? See the next one. Now you have to tell me which function will you use. Investment costs this, returns 300,000 at year 2 and 3, 400,000 at year 4. Now, guys, can you go to the PMD function here? No, you have to go to the cash flow function. So this is going to be my CF0 negative. Remember, what is going to be my C01? Can anyone tell me what is going to be my C01? Hello, hello, hello. Let me know what is going to be my C01. 0. Yes, very good. C02 will be 300,000 and you can put frequency 2. You can put your frequency as how much? 2 because it's repeated twice, right? And then your C03 will be this. Okay, let's do that. Second clear, cash flow second clear. My CF0 is 775 negative. C01 is 0, enter. C02 is 300,000, enter. But I change the frequency to 2. Instead of putting manually, you can just play a bit smart here. C03 is 400,000, enter. And then they ask me to calculate IRR. So just press IRR and compute. And wait, take a deep breath. You will have 8.65. Are you getting 8.65? Check, check, check. Everyone getting 8.65? Confirm me. Okay, great. Perfect. Yes. These are the maximum variety. Very interesting and very easy to solve. Correct? Now we are going to the topic where you have Modigliani Miller and various theories, theories. Okay. Here, static trade-off theory. See what Modigliani Miller said, that go for debt. Debt is helpful. But static theory said that as you keep on rising more and more debt in your company's capital structure, your equity becomes riskier. So it's not that you can forever go for debt. Beyond a point, debt will backfire. That is what static trade-off theory said. So they said you can keep on increasing the debt as long as the company benefits. Okay. So did they say debt use should decrease tax rate as increases? No, this is what Modi Gilani Miller said. Debt is always preferable to equity. Again, this is what said. There is an optimal debt proportion that maximizes the firm value. Yes. That's what static trade-off theory said. It said that there is a point at which the debt, beyond which the debt is not feasible. So even if the bank is giving you funding, doesn't mean you go on taking unlimited borrowing. You will take borrowing as long as the value of the firm is maximized. Understood, everyone? Correct. So the balance between the benefit of debt, tax benefit of debt, remember tax shield, and the cost of financial distress, that point is called optimal capital structure. Understood? And that is the foundation of static trade-off theory. Clear? Next, very easy. A firm finances 25 million expansion with 10 million in debt, 15 million in equity. So guys, how much is my weight of debt? 10 over 25. And weight of equity is 15 over 25. Correct? They said cost of debt is 10 percentage, but we do after tax, right? Interest 1 minus T. So we have tax rate. This is tax rate is 35 percentage. So I'll do 1 minus T. That is 0.65. And cost of equity is 15%. These are so easy questions that if you don't give me 100 on 100 on corporate, please don't talk to me. Easy. So 10 divided by 25 into 10 into 0.65. Store 1. The next 15 divided by 25 into 15. Store 2 plus recall 1. I get the answer. I'm sure you've got the answer 11.6. Let me know if you got 11.6. If not, you have $1 million fine. Easy? Easy, easy. Yes. Approach, Modi, Gilani, and Miller. Modi, as I said, is the current Prime Minister of India. Gilani was the past president of Pakistan. So together they came and did this, right? No. Modi, Gilani, Miller, very famous economists. They got Nobel Prize in economics for this, right? Under proposition 1, no tax. When there is no tax, the firm value, see what Modi Gilani Miller said in the beginning, model, when there was no tax, they said that does the capital structure matter? They said it doesn't matter. They said the theory is called capital structure irrelevant. So whether you go for debt or equity doesn't matter, right? The WACC always remains the same and the value of levered and unlevered firm is same. This is what they said in no taxation. So the firm's value is unaffected by capital structure. That's what they said. Increases with more debt? No. Decreases? No. So here, whether it's a unlevered firm or a levered firm, its valuation is the same. This is what MM said in MM Proposition 1 with no taxes. With taxes, they said that the levered firm is more valuable than the unlevered firm. Means having debt is more beneficial. Correct? Understood? This is what MM thought. MM told the world, right? So what, as per MM, companies which borrow are more valuable or they don't, those who don't borrow are more valuable in the tax world? Please tell me. As per MM, borrowing companies who borrow are more valuable or companies who don't borrow are more valuable? Those who borrow are more valuable, right? This is what MM said and he got Nobel Prize in economics. But guys, what did our parents say? Don't borrow. Don't borrow. What do the rich do? They borrow. Right? So we have probably thought wrong things. So we are always taught wrong things. That's why, we are not the Ambanis and Adanis. These guys, their parents were inspired by MM. So they were told, borrow, borrow, borrow. We don't borrow. So if you're poor like me, so that's because we don't follow MM. We should follow MM. They got Nobel Prize. Understood? Clear? Okay. Next, under the static trade-off theory, the optimum capital structure occurs when the value of unlevered firm is maximized. The difference between levered and unlevered firm is maximized. Financial distress costs are minimized. So close. Let me know which one. A, B, C. C. What is optimum capital structure? It's the capital structure where the benefit and the cost they set off each other. So that is the point where the levered and unlevered firms difference disappears. That's the best point. So the difference between the levered and the unlevered firm is maximized or minimized? Maximize. Remember here, what is the optimum capital structure? Optimum capital structure is a point where you can keep on increasing the debt as long as the company's benefit is higher. Beyond a point, you should not. So, where is the value maximized? Value is maximized where the tax benefit is greater, where the tax benefit is greater than the cost of financial distress. Till that point, you will keep on borrowing, borrowing, borrowing. So, as per the static trade-off theory, you should keep on borrowing as long as this is the situation. Then your company's valuation is better than the unlevered firm. So that is the static trade-off theory. Understood? Clear? Clear? According to static trade-off theory, the reason I'm sure you must have gauged why am I putting static trade-off theory again and again and again. Okay, you must have understood that. Cost of equity is flat? No, cost of equity keeps on rising as you borrow more and more, isn't it? Correct? Tax shield increases, then decreases. Tax benefit, yes, initially increases beyond a point. It's not the tax benefit goes down, it's the cost of financial distress which goes up. WACC initially decreases, then increases, yes. So WACC initially decreases and then increases. Correct. According to the static trade-off theory, what happens? Initially, your WACC reduces because you go for more and more debt, and then beyond the point, when the cost is higher than the benefit, then the WACC keeps on rising. That's the point where you should stop. So this point is called your optimal capital structure. Understood? This is your best point. Beyond that, the WACC starts increasing. That point is your static trade-off theory. Understood? So WACC initially decreases as you borrow because debt is cheaper, then it starts backfiring. Got it? Everyone? Now we go to the last topic, that is business models, where you have different forms of how to price your product and all. Okay. So suppose if a company is using tiered pricing. What is tiered pricing? Where the more quantity you buy, the more you buy in bulk, the price per unit goes down, right? So it's for bulk buying. So tiered pricing means charges more during peak times No, that is dynamic pricing. Airlines do. Offers discount for larger purchases. Yes. So the more quantity you buy, the lower is the price. Use low initial pricing. No, that's for penetration. Okay. So the answer is B, 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 B. Tiered pricing is related to volume. Remember it. Next, a company offers 50% off on slow days and charges 20% more on busy days. Who are these sort of criminals? Aren't they the airline companies? They charge so high when there is a festival, right? So, which pricing do they use? Can you tell me, everyone? Everyone, check, check, check. They use dynamic pricing. Have you heard about this or not? And have you experienced this that if you check the flight prices on iPhone, they're different than on the Android phones? I initially thought it's a joke, it's a WhatsApp joke, but I experienced it. Have you realized that? That if you see the flight prices on iPhone, they are different. And if you see the same flight prices on an Android phone, they're different. Are you aware of this or not? I saw it. I'm not promoting such a stuff, but it can be a rumor, but I also thought it's a rumor and I myself checked it. So this is dynamic pricing. Got it? Okay, yes. Uh, of course, if you don't get it, it's not my fault. Okay, but I have seen it because I booked the flights and I see, oh my God, what is this? But of course, it's not a huge difference, but there is some difference. KRD company is a B2B business. KRD is my company. I have businesses in multiple locations. I have businesses in more than 190 countries. So that's why I use this. Is a B2B business, business to business. This means it sells products and services to other business. Understood? Easy? So easy. I know you all are thinking, why are these so easy questions? Why is there not anything tough? No, there's nothing tough in corporate issuer. This is like your, amongst all the 10 topics, corporate issuer, some students ask me, is it really so easy? I tell them, yes, corporate issue is the only topic that is given to you to make you feel happy and to tell you that, oh, CFA is easy. Otherwise, not other topics are so easy. Corporate issuer is like, just to light up your mood. KRD uses a direct sales model. Some people use direct sales, some people do, channel partners and all. So this is which strategy? Channel strategy. Channel strategy. So what is a channel strategy? Channel strategy basically refers how the product is delivered to the customer. Does the company does it by itself or via intermediaries? That's called channel strategy. Understood, everyone? Perfect. That's the end of your corporate issuers. As I said, around 11 to 16 questions you'll get in exam. Very easy. I've just tried to highlight on most of the important varieties. If you have any doubt, let me know. Otherwise, don't overthink about corporate issuers. I'll also confirm one more time. CFA Institute questions for corporate issuers does not have too many questions in the end of the chapter. They have, I think, case studies. So you can do other resources as well. Perfect. Everyone? All right? Yes. Okay.